Hi, my name is Roger Schlater. Today's video is on how did SBA become the loan of choice to a lot of entrepreneurs and people with existing businesses. I don't really understand it. I'm surprised by how many existing businesses and new businesses that check out SBA loans when needing a business loan. Like I've said before, I really think you should probably go ahead and check with your local bank first, or several local banks first, and then see if you can get a conventional loan. Because a lot of times if a conventional loan will be cheaper, number one, and then number two, a lot of times if you need an SBA loan, your local bank will usually tell you you need an SBA loan. So anyway, usually an SBA loan is when there's a problem with the conventional loan. So they don't want to do a conventional loan, so they'll go ahead and go ahead and do an SBA loan where they feel more protected. The business loan, why would you pick SBA right away? Kind of like, is it from, something you've heard, is it because of SBA marketing? Is it that banks make more money off SBA loans? So anyway, first, let me say SBA is a great place for getting information on business planning and beginners in business. They have a lot of information on their website. For banks, SBA tells them, all about loans, as well as how to make the loan, the procedures, of SBA loans, how everything works. So they do provide a great service. I kind of wanted to set the record straight. The first part I brought up, is it what you heard? Only believe information that you've heard either from SBA directly or from lenders that have a deep knowledge of SBA loans and procedures. And then the second part, SBA marketing is really focused on expanding its program, trying to get more money next year. They brag, I shouldn't say brag, they tell people about how many new loans they've done, the number of jobs they created, and the number of the dollar value of investment that was made in your community. So anyway, they provide those services. But do banks really make money on SBA loans? You betcha they do. Banks that focus on SBA lending, they're mainly doing SBA 7A lending, and they can make bukus of bucks off of this government program. I mean, they can make a lot of money. So let's start with how banks make money in the lending process for people that don't know. Anyway, banks lend out money, and then they get a spread over their cost of funds. Now, you're thinking a spread over prime rate, right? No. Prime rate is what banks charge their best customers on short-term loans. So let's say that a substantial amount of lendable funds come from deposits to the bank. Now is a very low-rate environment. Banks, the interest rates are very low right now. So banks are paying about a 0.5%, and I think you're lucky if you get that. So anyway, they want to lend at prime to their best customers. But you'll not get their best rate because you're not their best customer. Yours will be above prime rate. So let's say prime rate is 3.5%, which is pretty close. This brings their spread to about 3%. Because they got to pay that 0.5% to the depositors that have the loans. So let's say their spread is 3% because it is on their cost of funds. So anyway, if it is, then that brings their spread to 3%, but your loan will be above prime, so it'll be 1.5% to 2% above what prime is. So anyway, now the spread is 3% plus 1.5. I'm going to give it a benefit of the doubt, say he's doing it low. So that equals 4.5%. Banks also charge a 1% origination fee, but this is a one-time charge. And that 1% over like 20 years would be that like increasing the interest rate about 25 basis points or about a 0.25%. So anyway, when we add that to the loan, then we're talking 4.75%. Now, let's say, 4.75% is decent money, I guess, for the bank to make. Some banks will say, oh, we don't make that, but I guarantee they make around that. Now the bank decides that, hey, you know what? We're going to do some SBA lending. And we're going to do it for two reasons. We're going to do it to reduce risk, number one. And then number two, we're going to do it to make more money. And that's really the big reason right there, is that SBA lending will make them more money. Now, they've decided they're going to make some SBA loans. If they really want to make even more money, they will turn every loan into an SBA 7A loan. And there's a few banks in our area that's actually done this and done this very, very well. But I've known lenders that work for them, and basically every loan is an SBA 7A loan. And there's a reason for that. The SBA 7A loan, the rate is basically prime plus 2.75. That's the max rate that you can charge on an SBA 7A loan. Nobody charges less than that. They all charge the max rate. And there's reasons for that too, and I'll tell you later. But anyway, so it's prime 350 plus 2.75 equals 6.25%. Now this will be reduced by about a 0.5% fee that the bank will have to pay to SBA annually. So anyway, your 6.25% minus your 0.5% will give you like a 5.75% for an SBA loan, where a bank you're only going to make like 4.5%. So anyway, SBA is looking pretty good. I mean, you're making, about a 1.25% additional spread on the interest, and you're also getting less risk because it's 75% guaranteed. The SBA 7A loan is guaranteed 75%, and this is a U.S. government guarantee. So U.S. government guarantees, or things that have that value, they can be sold to investors. So the bank can sell the guaranteed portion on the secondary market for SBA 7A loans, because there's a number of banks that are set up in that secondary market to market these 7A loans to investors. So that market is already set up. It's not like you have to hunt for an investor. All you have to do is call up one of these banks that sells these, that's in this secondary market, and you tell them, there's certain attributes that sell better. So anyway, you tell them what are the amounts that really are the terms that sell well, the years, and usually those are like the 10-year and the 20-year. Now the bank sells that 75% guarantee. So basically the bank, they get their money back, and plus a premium. And that premium is probably, I'm safe to say it's at least 10%. So they get their money back, and they get 10%. What a deal. Again, you get your money back in a 10% premium or dividend. But the bank will also get a 1% fee for servicing the loan. Now, you make up your mind. Which loan do you think the bank wants to make? Do you think they want to make the 4.5% conventional loan? Or do you think they want to make the bank loan or the SBA loan where they can actually get their money back and make 10%? What a deal. Now let's run that by you one more time. If you're a bank, you can make a conventional loan and you can make like 4.75% spread per year. Or you can do an SBA loan. You can get a 10% premium when you sell off that guarantee. Get your 75% the money back to relend, and do it all again. Just do it and do it and do it. And if you're a bank, you really want to make 7A loans, SBA 7A loans. But if you're a borrower, you really want to make a conventional bank loan. And that's one of the things that you got to keep in mind. if you can get a conventional bank loan, you're paying less interest, you're paying less fees. So anyway, make up your own mind. Would you rather pay 4.75, or would you like to have higher fees and make the bank a lot of money? I mean, to me, that's kind of a no-brainer. So anyway, this is the end of the video. If you like the content of business type information, and if you like in loans, commercial loans, please subscribe and hit the bell notification to get new videos right when they come out. And then if you take away anything of value in this, I hope you hit the like button. And really, thank you very much for being here. My name is Roger Schlueter, and I'll see you in the next video.